GameStop, short sellers. So what happens next? Hold on, because we're going to try to answer some of those questions in this short video. Welcome to the Money Growth Academy. My name is Dee. It's been historic and it's been exciting watching this civil war between short sellers and retail investors.
Interesting prisoners. Kill them all.
I wanted to take this time to step back for a moment to take a long view and ask one simple question.
During trading hours today, the biggest story was the collapse of GameStop. The video game retailer skyrocketed more than 380% last week on the back of a Reddit-fueled effort to squeeze the hedge funds that had sold the stock short. But take a look at it now. Since the highs on Thursday, GameStop stock has lost 81% of its value. Shares have plummeted even faster than they rallied.
Before we get started, smash that like button now. And yes, if you haven't subscribed, well, subscribe now to make sure you're up to date on financial news that matters, important stock analysis, as well as ways to grow your money snowball through the proper mindset, entrepreneurship, and investing. So what does happen when the last trade takes place? I'm just trying to figure this all out. Some brokerage firms like Robinhood have limited the buying of selected shorted stocks.
Why did you allow people to keep selling but not buying? The reason that is so troubling to people is that they were making money buying the stock because they were against the short side. And so by enabling them to sell but not buy, it sounds like you were allowing the hedge funds, and again, one of them owns a piece of you, and they had a big short position, and that looks like a stinky conflict that you didn't come out straight on from the start. Address that.
Well, none of that had anything to do with our decision to do this. Again, this was just looking at regulatory requirements, financial requirements, and we 100% will always protect our customers, where the entire business is operating to empower individual investors and has been since its founding. And that's what Robinhood is committed to continue to do. So we don't want to restrict buying in these 13 stocks. We're doing the best we can to re-enable it, as long as it's operationally and prudent from a deposit standpoint.
That being true, in the market, there's always two sides to a stock trade. If someone is selling, then there must be a buyer on the other side of the trade. And if someone is buying, well, there's someone that needs to be selling. But what happens to that natural market transaction flow if the only transaction available is selling, and very restricted, in some cases, complete stoppage of buying? What is the true market price of the stock that has been artificially severely restricted from buying? Who is put to the disadvantage? To me, unless I'm missing something, it appears that most of the disadvantage are those individuals that would like to sell their positions after having experienced an increase in share price appreciation. Meaning, if I made a significant profit on my GameStop shares and I wanted to offload some of it or all of it, how do I sell it and optimize the upside price of a stock high in demand but low in supply because it's being artificially restricted in the market? Because if the market demand is high for the stock, I'm selling, but the amount of the buyers available being artificially severely limited or restricted to very few buyers, am I really getting the best possible price for my stock? And if not, is there something lawfully wrong in this scenario? I mean, in every sense, aren't I being denied the opportunity to maximize my invested dollars? I'm sure that will be a legal battle for the courts to decide, and I'm no legal scholar, but the scenario I just explained just seems so wrong. So who wins this market civil war? for sure, there will be winners and losers on both sides. The retail traders will have made their point and let the big boys know that, of course, that they're watching and waiting to pounce. But there in the wings is another group of short sellers salivating, waiting for the GameStop shares to slowly roll back to reality, wherever that might be in terms of price. I'm sure there'll be a few hedge funds that got burned the last time and a few more new hungry wolves waiting to get a piece of the huge short selling opportunity that is bound to happen once the bow breaks. So who gets hurt in this exchange? Maybe some rich people, and for sure, some not so rich people. The not so rich may be those with less trading experience and might not have the digital trading reflex to bail as the stock rolls back with light speed back to reality, swallowing up all those that bought in the upstream but now caught in the vacuum without a quick way out. Some of the rich, well, they'll probably be okay in the long run as companies like Citadel Capital Management and Point72 shore up the shorts with $2.7 billion in cash in Melvin Capital Investments until it can get back on the other side of the trade and recover a 53% loss, believing the short squeezers, well, they can't hold forever. So who wins? I don't know. We might just wind up with a real standoff.
All right then.
On the other hand, it's possible that we see the swarm of retail investors moving throughout the market like a swarm of killer bees, infecting everything from stocks, metals, and commodity prices. The new market raiders? I don't know. What do you think? How do you think this ends? Thanks for watching. We'll see you next time.